Good afternoon, everyone. Tommy Grisafi, Advanced Trading and ATI Pro Media. We have a special show for you today. We have a big crop report coming up, not this week, next week, and we have some risks that's happening at the beginning of the year. I couldn't think of a better person than they have on the show than Mr. Dave Lechtenberg.
Dave Lechtenberg, Ames, Iowa, contributor, ATI Pro Media.
Look at that handsome devil on that pop-up. Happy New Year, my friend.
Same to you, Tommy.
What are we going to talk about today?
Oh, I think we'll kick off winter meeting season. We'll kick it off early. You know, the farmers are going to be able to go to a bunch of meetings here in the next 3 months. Let's just talk a little bit about what they're going to be presented with and what they need to be kind of concerned with.
Sure. And real quick for reference, that you spent how many years working in an elevator, and you celebrated several national pick up your check days, right?
Oh yeah, absolutely. That January 1st, you know, that when that day comes, there is a line at the grain table. There's no doubt about that.
Let's get in this show.
All right. If you could pull those slides
I
up,
will.
Tommy. For some reason, mine doesn't say add to stage. There we go. There we go. Well, like we said, winter meeting season is upon us. You know, you guys are going to be presented with a lot of experts. They're going to come to you and they're going to talk about the tight margin scenario that you have, and they're going to offer you price solutions to those tight margins. And we're no different. Tommy, I think next Thursday you've got for the Farm Future Summit in Iowa City. You're speaking in the morning, and then we make a mad dash across Iowa and are speaking at Guthrie Center that afternoon. So, you know, we're going to be part of those speakers out there. And so I'm not bashing these experts, but I'm just looking at it and saying, you know, as we look at our sheets, you know, kind of buyer beware when you get some of these price solutions that you're going to see. If you just set up for what we feel like's going on in the market, and you look at November 24 bean chart, and if you go back to November 21st, compare it to today, it feels a little bit like the market has got to have found a bottom. You know, I've heard more producers say that. You know, I've heard about the gap lower at the beginning of the week. You know, it's consolidating, but we got to remember, you know, just May 31st, that exact same contract in November 24 beans, they traded 11.16. So from a chart standpoint, you know, we could have another dollar down.
Yeah, that wouldn't be good. And this isn't good either. Let's see if we can hold this. But this is D's 24 corn just gently rolling over, going the wrong direction for the American farmer.
Yeah, we went from 565 to 499 today, or a little lower than that, I think, on the close. When I did this slide, it was 499. Hearing a lot of the 485 last May, you know, that's going to be our support. So we only have 15 cents worth of downside. You know, there's no risk to manage at this point. These are all the things I'm starting to hear. But at the same time, let's just go back to November 29th and look at D's 23 corn. It traded as low as 447. So there's nothing that says that we can't go back and trade those kind of numbers or lower at any point. You know, my whole point to all of these is don't let the market, don't get to the feeling that the market can't do something, because once we start feeling like that, it just says, hold my beer and watch this. And so that's what we have to be worried about. When we go to these meetings, you're going to get a lot of marketing alternatives. There's going to be companies that are going to offer the latest and greatest hybrid contracts, and they're going to talk about different strategies, scenarios, et cetera, et cetera. You know, so let's just kind of look at some of these alternatives. You know, one of the things that we are really promote are the options for the most part. When we're in a
David, sorry to interrupt you, but who wants to sell a bunch of futures below their cost production?
Exactly. That's exactly right. That is 100% what's going on. You know, and if you are going to sell your futures at below your cost of production, you're probably a little bit in panic mode. You know, you're afraid that all of a sudden, geez, I'll take a 30 cent a bushel loss as opposed to a 60 or 70 cent a bushel loss. And so all of these things are really emotional. And we want to try to eliminate some of the emotions. And that's why I like using the options. I think one of the biggest advantage of the options is it does do just that. You know, it allows you not to be so emotional about the market. They cost money though, and this year, tight margins, you know, it's an expense that gets scrutinized right away. Same time, you got to look at it and say, well, doing nothing can get pretty expensive too, because doing nothing is a market alternative. It's
It is,
waiting
yes,
for
sir.
higher prices.
Store and ignore, as the fancy internet boys call it.
Yes, exactly. Go back to last December 23 from June
Oof,
21st until November. If you chose the marketing alternative to do nothing, that the cost of that strategy was $1.82 a bushel, from where the low was in the fall. If you flip it over and then say, well, there's if I do something, if I'm like Tommy was saying, if I'm going to come in and do the little bit of the panic selling, but I don't respect that there can be upside, that can be pretty expensive too. And we don't even have to go back very far to get a lesson on that. Look at November 23 beans last May. If I'd have been in that 11:30 listening to the crowd that was talking $10, make a sale out there, that
You don't need to answer that.
yeah, no, I don't. I think it's for you, in fact.
I got it. Don't worry about it. Let's go.
But anyway, so that 11:30 making that panic sale there and not respecting the upside to 13.72, where November beans went off the market there, that strategy cost $2.41 a bushel. So
So
there's
if you panicked and sold it down that low?
yeah. So we look at an
Mhm.
awful lot of times, we look at it and say, geez, options are expensive, but every marketing alternative is expensive. You don't have to look very far into the past and see how accumulator contracts were
Mhm.
expensive. They all have an expense. Some of them are initially out of your pocket up front, and some of them come out of your pocket later.
Yeah, I barely remember us going that low. I wanna go back one slide.
Sure.
We were
Yeah.
down to 11.30 in Nov 23 beans and then rocketed out there to those great prices. Wow.
Yes. Yeah. That May 31st, right before
That
that
was a
stock
monster
and
move. Yeah.
yeah, that was a big deal.
There we go. Explain this one to me.
So this is I've used this for years, and I've named it different things. The 3 steps to marketing success. Today I'm calling it the pyramid of marketing success. Essentially, what it is I like to keep things simple, and so I try to break it down into 3 different aspects. The first thing, if we're going to be successful marketing, if we're going to look at some of these different alternatives that we have, the first thing that we have to do is we got to get control of this market. And by that, what I mean is we have to establish a floor price to where lower prices don't hurt us. And at the same time, we have to maintain some upside potential so that if opportunity presents itself, prices go higher, we can partake in that. That gives you control of the market. Too often, I think, and they keep going back to this same example, but too often we get into that panic type of a mindset and we say, I got to make some sales. I got to get control of this because I can't take $4 corn or
Mhm.
lower type of a thing. But the reality of it is you really haven't gotten control. You got control of the downside risk, but now you just opened up, gave up total control of any upside opportunity. And when you're trading in these type of areas, we definitely want some upside. So the whole main base of being successful marketing is first and foremost get control of your marketing. Once you get that, then you got to come in and say, okay, but what am I going to do? Because here at Advanced Trading, the first thing we'll tell everybody is, hey, we don't predict price. We can't predict price, and nobody can predict price. But the one thing that I will go out on a limb and predict is that the markets are probably going to go up or down at some point in the next year. I doubt that they're going to stay the same. We're basically going to bet on volatility of the market. So knowing that, we want to come in and say, okay, if I've got control of this market, what am I going to do when it goes up? And what am I going to do when it goes down? So we want to manage those trends. We want to look at how we can reposition into lower markets, have that plan in place and ready to go. And we want to look at how we can protect some profits if things go higher. So we get that middle part of the pyramid done. And then the last thing that you hear so many people talk about is, oh, this volatility in the market, it's just killing me. It's just, I don't know what it's doing. I can't keep up with it, etc. Well, if we have control and if we know what it's going to do if it goes higher and we know what it's going to do if it goes lower, well, suddenly we're going to like volatility, because if a higher market means I get to add to my profitability, that's great. If a lower market gives me opportunity to reposition, Well, that's great too. And so that kind of breaks it down when you look at all these different alternatives that you're going to be getting, this next 3 to 4 months here in this tight margin structure that we have. Let's look at the pros and cons of everything there, and let's talk through our alternatives. That's what we're here for, Tommy. That's part of why we get
Mhm.
paid.
Yeah, it's just because it's the market's drop doesn't mean we quit marketing. That's I've heard the word frozen a lot the last few days, that the American farmer's frozen, and I know they knew this could happen to them. I guess they didn't think it would happen so quickly, and they're thinking maybe, well, when do we get out of this? It could be years. It could be
Right.
years before we get to massive profitability. It could also be a few months with a weather problem in
Yeah.
South America or big demand popping up somewhere.
Yeah, that's probably the thing that's changed the most in my 30 plus years is everything happens so much quicker than it ever used to happen. And so we look at this and think, geez, we could be in a down cycle for 4 to 5 years. It could be over in 4 to 5 days. You just don't know anymore in this
Yep.
world.
Yeah. What do we have for solutions for the crowd?
Well, if we're going to stick with our marketing and come in and say I need to be in control, there's really only one good way to be in control, to where you have downside protected and upside potential or opportunity, and that's to utilize some options. There's a hundred different ways to skin a cat, and so I'm not going to sit down and say this is exactly where you want to be. But one of the ways that we could come out and look at how can I get protected going into this USDA report next week is I've got a whole bunch of unsold corn. Maybe I just go out and buy a March short dated put option, my least cost type of a marketing strategy. Market's trading around $5 or a little less. Well, they were trading for that put option, a floor with the upside potential is 10, 11 cents. You could be right at the market. That doesn't sound real bad. Downside is it doesn't give you a ton of time. Um, but like with anything, time costs you money. This is hedging corn. This is basically if you come in and say, okay, I'm going to make that sale. I'm going to come in and sell some corn here. Now I've got my floor covered with the sale. Now what do I do? How do I get some upside opportunity? Well, let's go out and look at some call options. Same
Hmm.
March short dated calls. Yeah, pretty darn reasonable there too. $5 right at the money, about a dime again.
That's not that bad. Now they're not buying a lot of time, but
Right.
it's a choice. Real quick, Dave, I just put at the bottom here on the ticker USDA Friday 11 o'clock 1/12/2024. This is what we're talking about. Uh, we could also rally a lot on this report too. So I would hate to see someone just pitch their coin, say heck with it. I'm tired of fighting this fight, and then all of a sudden, it is not out of the realm to say we could go limit up on this report. When we're breaking 8 cents a day in corn, I think new limits are like 35 cents. We could go limit up and still be 490 corn, folks. So do not think we can't go up. Do not think we can't go lower. I think Dave's given you a couple solutions here that could do both sides, correct?
Yep. Great observations though. Now you can do these same things that we just talked about, like Tommy just said, that doesn't give you a lot of time, doesn't protect you much till past February 23rd. Well, you can do it anywhere in between. You can pick April, May, June, July, all the way out to a traditional December
Traditional.
one. Yeah, they're just going to get more expensive. You looked at that $5 put on the short dated 10, 11 cents. If you want it all the way out to next December 24, you're going to spend 40 some cents. Nothing
Mhm.
wrong with that. It's just that a guy needs to look at what works best in your operation and what fits what we want. Do we want to manage it all year long, or do I just want to establish a floor and have it in place until next year?
Right. And we do not have crop insurance. Big deal.
Correct.
It's not that the markets went down and there's a crop report coming out. It's that you're out of control in two crops. So when you go back to Dave's pyramid, get in control of the lower dark green, you're kind of out of control in 23. I have a feeling in corn. You have your beans managed pretty well. Um, and there's a lot of different reasons why people are holding on beans for longer with carries and whatnot. But the corn, I feel like the American farmer, not only the American farmer, David, but the world farmer is caught long commodities. It's not just an American thing. It's not clients in North Dakota. It's not clients in Iowa, Indiana. It's not my clients in New York or your clients all over. The world farmer is caught long commodities because we had this mega bull market. And in my opinion, they got a little too comfortable betting that Ukraine wasn't coming back online and that the world wouldn't overproduce. And we finally caught up to having enough production for the amount of demand currently. That's my opinion, but the mathematics and the spreads and the basis and everything else reflect that. Would you concur, Doctor?
Yep, absolutely.
What else do we have for the good folks today?
Well, just looking at taking the call side of that, if I decided or if you decided that you wanted to make that sale and buy calls, here's where your cost structure is. $5 corn, 540 call option can get that bought for 26 cents. One thing you might want to consider is there's not a ton of carry into the July of 25 actually. And if you want some calls and you want, to get out that much further, it's not that much more expensive to add time all the way to the July.
That's
So I mean,
interesting.
there's different scenarios.
Hmm.
There's just like we said earlier, there's 10 different ways to skin a cat. You just have to get comfortable with the way you're doing it and then work from there.
Very good.
So that's kind of the corn side, Tommy. You got anything you want to add to that?
No, we have our beans, and people love talking about corn, and we'll go over the bean numbers and the bean options. But I feel like it's just more fun talking about corn. But we do have to address the beans because it's a serious situation, especially for the No 24 beans that people have no floors on.
Yeah, exactly. And then that's just the thing is people don't have the beans covered either, and so not as much fun, but you still got to look at it. I'm not going to say anything different than what the corn side of it is. I'm just going to give you some of the numbers. You can do the short dated floor with the put options, just like we were talking for $12 floors. You can have 10, 11 cents invested, get you through this report, gets you into 2/3 or better of
February.
the February of the crop insurance month. Not all bad there. Same side, flip over. What if I made sales and bought some calls? We can keep that upside fairly reasonable again. 1260, 1270 call options. These are short dated. These are based off the November 24, just expire with March, this expire on February 23rd. 10, 12 cents. It allows you to come in and get control of the market. Make a
Yep.
sale, creates your floor, buy the call, opens your upside opportunity.
I just don't think many farmers are going to make sales at this point. But as you go in to renew operating in the next few weeks and months, it's going to be embarrassing if you go tell your banker, I planted 550 corn and I was so scared to sell it at 550. I sold it at 4 and
Yeah.
I've done nothing for 24 and I have nothing done for 25. We work with all types of people who have a lot of old crop or no old crop. I right before I filmed this, I talked to a client. You overheard me, Dave. He is 100% hedged on 24 crop with a combination of cash sales and a beautiful $5 put in D's 24 that he put on 3 months ago. So he's
Yeah.
feeling good. It's I wish I could say that every client I have, every client you have, every client Advanced Trading has had a floor like that, but it's a choice, and we could suggest choices, but we can't actually make you do it. It's not it's not an accumulator. It's not working overnight. It's a decision you have to make. Now, to my friends who sell crop insurance, they say that, oh, we do is easy, but what they do, I think, so simple in the fact that if you don't take crop insurance by this day, you are not in the crop insurance program. So we talked to you about buying insurance throughout the day, throughout the week, throughout the year, throughout the month, for multiple years, for multiple crops. You sign up for crop insurance on this day or you don't. And that crop insurance agent either has a client or they don't. Is that correct?
Yep. Yep. Absolutely.
So I feel that we're asking you to do more often, but when you don't, and we slip like this, or if we get one of these $2 rallies, you're not participating.
And we do ask you to do more often, but I think that's probably the advantage of this too. If there's a downside to the crop insurance, is you just do it. It is just one shot. It's the average month of February, or actually two shots, or the average month of October, and in between any market volatility. We talked about one thing I'll bet on is that the market's going to stay volatile, that we're going to go up or down. Well, this allows you to manage that up and that down.
Yeah, that makes sense. What else do we have for folks?
Yeah, then so just extending this out again, again adding some cost to it, getting out to the new crop, you're going to spend 1140, you're going to spend 35, 36 cents to establish that as a floor, a net floor of around $11 futures after you figure the cost of that option, or you can spend a little more and get a $12. But there again, it gives you some floors. Tommy, you had made the comment just a little bit ago and said that, I don't see any people making sales. One thing that might make people want to make sales is if that banker starts to get a little nervous and you come in and say, I'm going to buy a $12 put. I'm going to spend 60 cents for it. I've got an 1140 futures. Whereas if I make a sale, I can go do a hedge to arrive, get a futures floor of 1225, considerably higher. And then I can just come in and say, okay, what do I need to do from a call strategy? And I can probably come in and spend 30, 40 cents on a call, take it off my 1225. And now I've got a 1180 type of a floor. And so if you look at that, it gives you a better floor. You have less upside because you're going to buy a call out of the money, gives you a better floor. So both strategies do the same thing for you. They give you a floor and open up the top side. Using a put, you got a lower floor, but in exchange for that, you get all the upside. With the call option and the sale gives you a better floor, but you get less of the upside, as that market comes up.
It's very real, right? So the predicament we have is crop report coming up, no crop insurance, shipping problems all over the world, a lot of geopolitical risk. We talk about that daily on ATI Pro Media Live at 9. Anything you want to finish up with, my friend?
No, I think that kind of wraps up what I had for you.
All right. Well, there we are. That's how you listen to us every day. ATI Pro Media goes live on Advanced Trading YouTube. We send you links and text to that. Tell a friend. It's free to the world. ATI Pro Media Live at 9, always be free to the world. You can listen to us on Spotify and Apple. We appreciate your business. This video will be sent out to Advanced Trading clients. And with that, I think my wife, Gina G, wants to say something, buddy. Thanks, David.
You bet. Thanks, Tommy.
Thanks for joining us. We're here every day, 9 a.m. Central. Don't forget to like and subscribe. We'll see you next time.